Hello, everyone. Thank you for joining us for today's live webinar with Trullion and Deloitte. Today, we'll be discussing SPACs, IPOs, and life in a rapid growth finance organization, how to leverage AI technology for lease accounting and more. Before I introduce our speakers, I would like to remind you all that we will be leaving time at the end of the session for Q&A, so feel free to write us all of your questions as they come up or at the end of the webinar, and we'll try to address as many as possible. Now, I would like to hand over the stage to today's speakers, Isaac Heller and Ashok Parmar.
Okay, wonderful. Thanks, Shoshi. Ashok, good to see you again.
Likewise here, been a while.
Yeah.
Santa Barbara roundtable was in person. Zoom works for the time being, I guess.
That's right. Well, I mean, Ashok, every time I hear someone about that's doing an IPO or SPAC or, cleanup on the West Coast, your name seems to be involved. So it's good to see all the activities since we last had a chat like this. But I'm really excited about this today. Just by way of introduction, again, thanks Shoshi for having us. Isaac Heller, I'm one of the founders here at Trullion. We are what we call modern accounting technology. Just from a personal level, I spent many years in rapid growth organizations in Texas and New York, living through ASC 606 and in an IPO environment. I went on to work in real estate and lease accounting technology, and just learned a lot along the way around how much PDFs and Excel and spreadsheets needed to be prepared in order to be an audit-ready company. And Ashok?
Thank you. I'm based in Los Angeles and a partner in our accounting reporting advisory practice. I've been living and breathing technical accounting, capital market transactions, controls for most of my career. And I lead that accounting advisory practice for SoCal now. And we used to focus on a number of these things, but I would say for last year or so, we've been focused on SPAC transactions, probably as number one item, and then trying to keep up with everything else. Good to be here and good to be talking to folks that have joined, and happy to answer any questions as we go.
Definitely. So Ashok and I will get into things. And again, as Shoshi said, hold any questions, feel free to use the Q&A chat box, and we'll get started from there. So today we'll really talk about two things that combine some of the areas that Ashok and I work within. Obviously, life in rapid growth environments, like in the SPAC and the IPO rapid pace accelerated environment. And then I'll jump in and talk about how you could leverage technologies with your team, with your advisors, to bridge that gap. And we'll zoom into applying an AI-driven use case to lease accounting, one of the emerging standards. Sound good, Ashok?
Yeah, sounds perfect.
Got it. So I mean, we should set the scene, Ashok. Like we said last time we were talking, it was a nice coffee in Santa Barbara. Today, virtual work has taken over the industry. I was thinking about my experience as a founder in a VC-backed organization. We raised a round of capital, a multi-million-dollar round of capital from investors like Greycroft and Aleph, and we did it all via Zoom. We did all the legal and accounting work via Zoom. There is a member of our board of our company today, he's actually in LA, that we still haven't met. We have this virtual relationship, and a lot of our collaboration and compliance is done virtually. Ashok, I'm sure you've done some SPACs fully virtually or had some unique stories along the way.
Yeah, it's been really interesting, to be honest. If you had asked me back in March, and I'm sure many folks on the call can relate to it, that is it all going to be possible? If you think about Deloitte, we are the largest professional services firm now, which means we have a lot of people, and we recruit a lot of people every year, and it was a big concern. And if I just relate to my own team and plan, our plan was to recruit about 20 people. And of those 20 people that we recruited in last year or so, I haven't met 18 of them. And there are some transactions that we work through, like we literally were working 14, 15 hours a day, but we haven't met. And so it's possible, but at the same time, I think people are craving the human interaction, and it's starting to open up a little bit from our perspective. I think we started opening up to 5 people in the office. You can have meetings. And similarly, from your question on the transactions, there are probably 4 transactions. I haven't met anyone from the client. We work from beginning to the end. So it's good and bad. I'm curious to see how it impacts what we do as things open up, particularly here in the States.
Yeah, definitely. And I should mention, Ashok, we're calling in from Tel Aviv with our R&D team now. So we've had our own corona and vaccination experience, and actually some news in recent weeks. But everyone's been in the office, and it's been good. But there was a while there where it was completely remote. And so, I feel as I went through 606 and 842 personally, and now I read about CECL and cloud computing arrangements and equity comp. I feel like there's this almost pressure cooker or an increase in regulations, but at the same time, there's a lot of deal making, right? And there's a lot of appetite for deal making, and all of these and the virtual world have to be reconciled, and we have to keep up with the pace. So tell us about like what does this IPO and SPAC market really look like?
So, and I'm in SoCal, not in Bay Area. If you think about the IPO market previously, it used to be all Silicon Valley primarily, particularly in tech space, which is where I serve clients mostly in tech, SaaS, hardware, or other technology platform. And from advisors' perspective, we used to see one IPO maybe a quarter, or sometimes every other quarter. And you contrast that with what we've seen in last, I'll call it a year, it's less than a year. We probably worked on 18 or 19. I personally have worked on 9. With the capital markets being this active, I think I can say fairly certainly that I probably haven't worked this much in my entire career, even as a senior accountant. So that just resonates the activity in the market. And the shift in the market from traditional IPO to this SPAC transaction, which I think many of us know now, a special purpose acquisition company or a blank check company, shell company, you may hear different terms. The sponsors basically raise capital and take a vehicle public, and that vehicle looks for targets. And the SEC staff is pretty direct that you can't look for, the investors can't look for a target before they have a shell company. So now some of what I call serial SPACers or sponsors and private equity investors, they have multiple vehicles. Some of them actually have 12 SPACs listed already. So when they go look for a target and say they end up talking to 15 or 20 companies, now they actually like 2 targets. They want to acquire 2, or maybe they want to acquire 3. So they don't have to go back and re-register or raise capital. They can use one of those vehicles. So this SPAC overall phenomena has matured. We see a lot of, I would call serious experience, larger investors in the SPAC market now. 2 or 3 of the transactions that I'm working on right now, I could totally see them going via traditional route also. So that SPAC phenomena, I would say, if you ask me now, previously it wasn't as certain that it's here to stay. I think it's here to stay. And someone else I was speaking to last week or the week before put it very nicely, that if you think about public market transactions, you think about traditional IPO, direct listing, and now SPAC. Each of these vehicles or routes are actually impacting each other. Picking, call it best practices or leading practices from one to other, like the lockup period used to be long. In traditional IPO, it used to be 180 days. Now the SPACs didn't have that, direct listing didn't have that long of a lockup period. So each of these are sort of amending the how the transactions are consummated. Now, if you think about the slide in front of you and look at the SPAC phenomena, I called it, the market's being really, really active January, February, March. And then April, I believe it was early April, is when the market slowed down for a variety of reasons. One of them was the SEC's commentary on warrant classification. So SPACs, typically SPAC units are $10 each, but they come with a warrant, or two types of warrants, actually, public and private. And the discussion from the staff, then publication, and then people like me have been really busy since then, that warrants by shell company, the warrant should have been classified as liability versus equity. So that put a lot of pressure on all of these shell companies, or not all, I would say a large majority of the shell companies are audited by two firms, Markham and Witham, two smaller US-based firms that have taken on a large number of shell companies. So if you think about restatements or getting that issue fixed, there's probably a lot of backlog that they need to deal with. And then the pipe investment. The transactions, if you, I think this slide's probably 2 weeks old. If you do the May one now, I'm seeing the transactions come back, even some of that were put on the hold. So I would say the market's active, the players are getting refined. The deal flow that we are seeing now is larger, more matured companies and larger, more matured investors. That's probably how I would describe it.
Got it. And so Ashok, I mean, I'm a founder of a technology company, and maybe there's a staff accountant on this call. What between IPO, SPAC, direct listing, are they all the same in terms of how much compliance readiness is required, or are some a little bit more complex than the others?
I think that's probably a good segue into our next slide, or the slide after I can use. So if you push to that one here. So folks can read some of the bullet points, but that's an excellent question, Isaac. If you think about different vehicles from your point of view as a founder, or folks that actually would need to do all of this work from their point of view, not that you won't do much work, Isaac, but the different perspectives.
We just pay the bill.
Important part. The traditional IPO has been long there. Folks know about it. And I think what I typically see traditional IPO route, companies start preparing in advance. And in fact, rehearse some of the close investor presentations, earning release, and filing exercise, board presentations, which is critical. If you can do that as a company, then you are way well prepared as you become public. You still will have to deal with the public company compliance, but that angle I typically see is not the case with SPACs. And because the deal flow was quick, the offers and the enterprise values, market multiples that were offered in a recent market trend just didn't give those companies time to prep, similar to a traditional IPO. And direct listing is basically a different pricing mechanism. So to answer your question on the level of effort, the level of effort I would say is similar. A traditional IPO and direct listing, you are looking at S1 registration statement, and SPAC transaction, you're looking at S4 registration statement. The SPAC transaction, the reason I explained the timeline and the preparedness, we see the SPAC transactions, compliance exercise, and filing typically is a fire drill. That's because of the company probably going public when they were not really thinking about it. Even though they had a solid business, they probably weren't preparing and practicing all the quarterly close and some of the other items I mentioned. The overall form, in terms of form S4, also has some other nuances, I would call it, because now you have numbers from the shell company and the operating company in the same document. So that dealing with sort of two tables, if you think about it simplistically, pro formas, if you think about pro formas, that S1 may not have it, but in S4 you do. So I would say 70-75% of the activities are consistent. And then SPAC, you tag along some of the additional items, and then you make it in, you fit it in a shorter window. And that's where it becomes the SPAC frenzy compared to traditional IPOs. If you ask me as an advisor, Isaac, I think every time I get a traditional IPO related transaction now, someone wants to go traditional route, I'm really happy, because that would seem like piece of cake compared to a SPAC transaction. I don't think I would have said that a year ago. So if you look at some of these other items here, I think the activities that you would want to think about, Isaac, on these, or folks that would need to not just transaction, but in terms of being ready, even if you were not considering a public filing right now, like some of these other items, and that's where I think some of the areas that we would discuss subsequently will fit in, like close process and timeline. What can you do now? Because this is going to be relevant to you, irrespective of whether you are going to consummate a public market transaction or not. Like refining your close process, producing your books in a quality and timely manner. So I would heavily focus on that, but also heavily focus on accounting policies. And we'll talk about 606 and 842, some of the complex areas in a little bit. And then the technology solutions on the right hand side of the slide here. Companies typically, I think it's a fair statement, particularly if you are 2 years ahead of your any sort of exit transaction, the companies typically tend to muscle through a lot of this close process and bunch of Excel workbooks for, say, lease accounting, revenue recognition, cash flow statement. If you have a route that you will be a public company or you'll be a large company looking for some sort of transaction, I would think about investing in technology solutions. That's something that I don't typically see, but whenever I see that, that's a success story. And then going back to our virtual comment, I think that was one of the big differentiators for the companies that were successful, that were able to do transactions. They had right tools and technology in a manner that was protected.
Very good. Well, I'm a traditional guy, so when you say traditional, you know, we would go down that route. So Ashok, you want to zoom into a couple of these areas which you've mentioned in terms of audit readiness and rapid growth environments?
Yes. So if we think about, let's spend some time on these two areas probably, and then we can go back. And
I spend way too much time.
So.
I spent way too much time on these areas already in my lifetime. I don't know about you, but
I did when the revenue standard came. Personally, I think I helped 35, 40 companies adopt the standard. So I've seen it quite a bit, and I was back in our national office, as you know, Isaac, and so I do have some connection to these standards, both revenue recognition and 842. So if we talk about revenue recognition, I think there's a slide that has the model. Let's go to that, and then I can describe some of the areas. So private companies, and when I say revenue recognition, I think it's fair to say that the standard's consistent between US GAAP and IFRS. So if some of the folks are thinking from IFRS perspective, these comments would be relevant there as well. There are some nuances, but largely it's consistent. I can't say that for the lease accounting standard, but revenue standard, I think they were able to align it for the most part. So if you think about the new revenue standard from the accounting perspective, and then we can talk about operationalization in a second. It was a complete overhaul of the guidance. The guidance went from the rule-based guidance to principle-based, and the control concept was introduced, which in practical sense, I really like as an accounting advisor. And I think it helps us think through the transactions more. Practically, do you get the answers that you always like? Maybe not, but I think it's a little bit more relatable if I just think as a technical accountant. So if you think about the new revenue recognition model, we refer to this as 5-step model. And we don't need to get through each of these items in more details, but at least just higher level. Think about it from your contracting process to recognition of revenue. That's what these steps are taking. If you go from left to right, you would see contract identification of the contract. Do you have a signed contract? Is the consideration collectible? Areas like that. Termination provision, you think about that. Now you also, and we can zoom in on that in a second, but if you don't have your contracts in a manner, I know ISAC and I call them smart contracts, but if you have these contracts in boxes somewhere, or I use boxes probably more exaggeration type term, but if you have these in large PDFs and not in a structured manner, that was one of the large struggles for the companies to adopt, and it tends to be a struggle even today. Like whenever they enter into a new contract, how do you ensure that you've identified all the terms without reviewing the contract, like somebody literally going through it and preparing a checklist? How do you deal with that?
Right. I mean, Ashok, this is really when the light bulb started going off, in the AI world, because if you look at, as I think back to revenue recognition, and it's still going on. It's going on in our company today. We are in an early stage environment where we're going to have to move to 606 very soon. But, we were looking at tons of contracts from different business models, SaaS, license, on-prem, reseller agreements. And it was so interesting to go through the new standard and look at something like a cancellation clause that was midway through a 2-year contract or a 4-year contract, an opt-out clause. And, we were recognizing the full value of that contract like any software company would, but under the new standard, it wiped out, the second half of the agreement. And so for me, when I was going through these agreements, we realized that all of this unstructured, PDF data was becoming a lot more critical to the workflow, whereas before it really didn't matter. It might have been a batch Salesforce file or something very straightforward where you take 2 things from an agreement. And so we really realized how much more time accountants, and auditors were spending reviewing contracts to bring them into compliance.
Yeah, and I think there are some solutions that companies can think through and consider, but I don't see even the larger companies using it and using technology in a manner that simplifies it, to be honest. Like I serve a number of really, really large clients and work with them on their controls around this area. And we put our heads together, but the best we have are these checklists on reviewing each of the contracts and documenting it. And those tend to be pretty time consuming. If I remember looking at one of those actually yesterday, checklist is like 20 pages or so.
Yeah.
And
yeah.
You don't have to fill it for all of it.
Yeah. I mean, we're working on this in Ashok. We see the same thing, and it turns into a double dip because you as an accounting team have to review it, and then the auditor in an ideal world is going to be reviewing some, if not all, of these contracts. And so the additional work on the accounting team side ends up being additional work on even an internal auditor's side.
It does, and then external auditors similarly have to follow the same journey. So if I look at 1 or 2 other steps probably here within the slide, allocation of the transaction price, which is basically when you have more than one item in your contract. That part is pretty manual if you don't have a solution. So taking that angle. So I think what I'm trying to highlight here is the standard itself is fairly complex depending on which industry you are in. And if you don't put the right processes, then not only this, if we go to the next slide, Isaac, you would see that if you don't accumulate put processes and perhaps automate some of this. Gathering all of this data is going to be what I refer to again, muscle through, which means you would put in a lot of extra effort, time. It will be audited internally with internal auditors' lenses, and then externally. Like a number of areas you see here from disclosure perspective, getting revenue by type, revenue by geography, or another byproduct, then that will take time if you don't have it in a manner that is consistent, that is controlled, that is accurate and complete. So I think within the new revenue standard, not so new anymore, we continue to see the challenges, and we continue to see companies calling us even after 2-3 years of adoption, when they enter into new transactions or when they acquire a different company. They acquire a company and now the process is not aligned, even though the overall business model is somewhat consistent. Maybe they've gotten to a different conclusion on certain areas. Maybe one concluded there were 2 performance obligations, the other concluded 3. Perhaps the facts were different. So I think my advice on this would be, Isaac, is to just automate, put a process in place to the extent you can. Otherwise, you'll end up spending a lot of time, which you may have to, but perhaps you can save that.
Well, our big one was sales commission and creating sales commission into a liability as a cost of the contract. So again, then we had the PDF coming in on one end, and this was in this unstructured format. And then on the other end, we had this sales data around comp and commission coming from other systems and in other formats. And it became a whole new world. Yeah,
commissions, if you think about that, Excel workbook, many companies have those. Those are huge workbooks, and you somehow have to control them to any sort of automation there, systematic fashion of collecting that data, reviewing it would be extremely, extremely helpful.
Got it. So yeah, I mean, Ashok, we're kind of drilling down, and zooming in. I mean, you look at the high level, which you guys take care of. Revenues usually number one I've seen. I mean, are there a couple of, before we get into lease accounting, which is a little bit more focused, are there any other top areas besides RevRec that you're seeing in terms of big objectives within SPAC and IPO readiness?
Yeah, I would say SPAC, IPO readiness, or in general for fast growing companies. The areas that come up pretty often are stock-based compensation. Obviously, the companies, their board founders, they want to reward the right people with the right type of instruments, and it typically is not one size fits all. And that makes sense from the rewards perspective, but then on the back end, it creates a lot of data and accounting issues. And warrant I mentioned was one example in a SPAC transaction, but financial instruments in general, like if you think about stock comp, you would have employee, non-employee. You would have awards that are based on service, performance, dual trigger, meaning service and exit. And all of those aren't easy. And then on top of that, you see modifications of those. Now you have to deal with all of the modification angle. So again, I would focus on the identifying the universe, putting some sort of processes in place, and having the right people review that. Financial instruments is the other area, Isaac, that comes pretty often. And when I say financial instruments, I would say convertible debt, convertible preferred shares, safe instruments, simple agreement for future equity. Each of those, like whenever you think about convertible options, you have to go through the accounting analysis. Even accountants don't like this topic as much, the derivative accounting, and figure out what options should be separated and or fair valued. So I think that comes up pretty often. In tech space, cloud computing comes up fairly often, and there's new guidance around cloud computing. So stock-based comp and financial instruments, there's not a lot of new guidance. I would say some options for refined recently, but cloud computing has newer guidance for SaaS companies. So I would say these areas come pretty often. And then as you start getting closer to being a public company, then earnings per share and segment reporting. Those are the two areas. Those are more public company related. And then in the US, at least, and I don't know, I don't remember the IFRS guidance top of my head, but in the US, you have the private company council, PCC, elections like goodwill can be amortized, or for lease accounting, you can use risk-free rate. If you are seeking and approaching any of these transactions, you'll have to unwind those. And that could be pretty painful. So if I were you, I would think pretty hard about making any of those private company type elections if any sort of public transaction is on the horizon. So those would be some of the other areas I would highlight.
Good. And we're zooming in today to lease accounting. This is a standard that's been in place for a few years for public companies, and now private companies will go into adoption this year. I was just talking with a company, and they are an IP. They just went public. They're classified as a EGC. Is that what you call it, Ashok? Emerging Growth Company.
Yep.
So they have a 2-year exemption on lease accounting and a couple other standards, but only a handful of leases, right? I think like 6. But this is a company that's got 6 leases, but they're in 6 different countries, and some of those leases have CPI and variable costs, right? And they're modifying and changing those leases this year as they're rethinking their space strategy. And it's a significant undertaking. There used to be this thought that leases was for asset-heavy companies and retailers and restaurants, but we're seeing, in our world, it's tech and it's fintech. We're seeing a significant challenge in this area. So, I mean, take us through kind of like Ashok. I mean, you're the expert here at the technical aspects and some of the readiness, and then I'm happy to break it down, into some of the AI opportunities and technological innovation areas.
Sure. Yeah. So from timing perspective, I think there's been some confusion, I would say. It's pretty straightforward for private companies.
When's the date? Ashok, everyone, when's the date? Just tell us when it is. It's changed so many times. What is the official adoption date?
It's changed, twice, maybe 3 times. The interesting part is it didn't change for IFRS, Isaac. So
That's
if you
true.
had both standards, then I think I have one client now that adopted it for IFRS and then is currently adopting it for US GAAP, and it's really
So
interesting.
funny.
And they have 800 leases, so it was somewhat painful for them. But
Wow.
The private company timeline, as you see in the blue dot and arrow, is January 1st, 2022 for private companies. And I won't be surprised if we see what we saw with public companies, where companies wait until the end, and then it becomes a fire drill. And sometimes, even if you don't have that many leases, which in tech space, you would not think you would have a ton of leases. But at the same time, you don't put that many resources on leases. So it's all relative. Like in a retail environment, you have leases, you have operations, and you have folks that are handling lease accounting currently. So you can leverage them. But if you're a tech company and you only have, say, 40 leases, you probably have no one focused on the leases full-time for sure, but perhaps not even as much attention as it would be needed for adoption of the new standard. So I would say the complexity and the effort sort of all relative. And my advice would be not to wait until the end, irrespective of whether you want to do it yourself or hire somebody or get a technology. Just at least put your heads together and put together some sort of like bullet points and say, here's the person who's going to do it. This is when we start, and this is when we try and be done with. So at least it's part of your priority list if it's not already. The emerging growth company comment you made, Isaac, that there's some confusion on that currently. If you think about the market multiples I mentioned before, if you lose your emerging growth company status, so we are in 2021, if you were to adopt it as a private company, which is what emerging growth company status basically allows you to adopt it as of 1/1/2022, but you went through a transaction and your market cap is large enough, or you end up losing that status. Then you need to adopt right away. There are some nuances you have to figure through, but that basically accelerates your adoption timing. I don't think people are thinking through that angle. And I got a call from one of the companies going through SPAC transaction in LA, and there was so much confusion, I could tell already, and they are adopting. They would need to adopt before the private company adoption timing. So I'll just caution folks about the emerging growth company status, and that test is somewhat straightforward, but you have to at least think through and put it. You may be really close to losing your status, but you can't adopt overnight if you have had more than a handful of leases. So you may need a few weeks head start to get there.
Yeah, absolutely. And the other thing that we've seen, I mean, we have a couple clients who have already IPO'd or are very close, and they never did 840 correctly, or maybe in some cases they didn't do it at all, right? And so they're having to adopt a new standard and also having to clean up a retroactive standard, which, I mean, the data is going to get thrown away after a couple more periods, but they still have to do this work in retrospect, and think about what a previous version of a lease was like a couple of years ago to ensure that it's within compliance. So again, another reason to kind of, get started as soon as possible. Ashok, the other thing, I mean, it's a technology company. We're sitting on a lot of agreements. You know what I mean? Like we're sitting on, so I mean, you've got the lease that says commercial lease agreement, right? Equipment lease. And then you've got, I mean, we're working with a kind of an ad tech company that doesn't seem to have a lot of leases on the surface, but then they've got all these arrangements and servers and equipment. And as long they uncover like a new lease every week, it seems like, but at the beginning, it was only a few.
Yeah, and so I go to these bullet points quite often, and I think the first bullet point covers what you were just alluding to. Finding leases is not a straightforward process. I mean, it should be intuitively. You would be like, what do you mean? It's not a straightforward process. I just get my agreements, put them in a list. But leases haven't been a focus area from what I can see, even as an accounting advisor. Companies, if I look through the list of calls that we used to get, leases would not be in last 5 years. Prior to 842, maybe they were not on the top 3, top 5, top 10 lists. So that simply indicates it wasn't focused as much. You typically treated these as expensive, and you had the 5-year commitment table. So there wasn't anything recorded per se in the balance sheet. And now it has more focus, which hopefully helps identifying most of these leases. But that basically means the agreements, the listing of the agreements perhaps wasn't kept in the neatest manner that you would need. And then the other item you mentioned is where we've seen companies struggle, and even advisors struggle, is the embedded leases, the arrangements that don't say lease on the face of the arrangement, but actually have or potentially have a lease. So that part, if there is a way, and I know Isaac, you probably will talk about some of the technology angle, but we spent quite a bit of time, and the companies spent a fair amount of time on identifying that. And now if I look at the next bullet point, which is somewhat related, if you think about the lease standard adoption and how you compute the entries from the non-discounted future payments, discounted and debit ROU asset, credit lease liability, right of use asset. It sounds pretty simple, but when you have to compute the entry, and I'm not exaggerating, I think you end up collecting 70 to 100 data fields from each agreement, which is challenging. And then reviewing, making sure it's consistent, it's quality, it's controlled. I think those probably have been extremely painful areas, just identification of leases, collection of data. So if there are ways to automate some of that would be lifesaver. And then that probably would save time and effort on an ongoing basis, not just the adoption of the standard, because you would be entering into leases and modifying them on an ongoing basis too.
Yeah, absolutely. And I mean, we live through this stuff, and we could come in here and we could say how AI would just be a flip of a switch or a snap of the finger and that it would solve everything, but it's really not like that. So if you kind of go back and think about the lease standard, there are certain areas where AI can be really powerful in using NLP to go through an embedded lease or extracting data that could have took 3 hours, it could took 30 minutes. Some of the areas are classic workflow-based accounting, but there is a lot of opportunities for AI to bridge the gap, not just in leases, but in other standards. And so like Ashok, I mean, I'm sitting here, as a client of yours, of Ashok's, as Deloitte, I'm thinking, I'm sitting in my organization and I'm thinking, wow, this is like incredible. I mean, all the things that I have to do, 606, 842, cloud computing. I mean, I'm taking notes as you're talking about stock-based compensation. Where I sit as a technology company is I'm saying there's a new era and there's a new horizon within financial and accounting technology. And the way we look at it is accounting teams and audit teams are really the pioneers of this stuff. A lot of people don't realize, but Oracle and SAP that really grew a lot in the 70s, 80s into the 90s, the key use case was financial technology, was organizing, getting a balance sheet, an AP and AR set up using technology. And so it went from databases to cloud databases, which just allowed more rapid acceleration of technology. So instead of being a big company with an accounting system, you could be a small company with a QuickBooks or a Xero or a cloud-based tool that could be deployed very quickly. Now it's a completely new era, right? You have all of these emerging standards and these unstructured data. And so a lot of the leading technology companies in the accounting space are embedding AI. Some of them are full force AI, where that's all they do. Where we fall in as Trullion is we obviously are cloud-based, but we use like AI as an embedded feature within the workflow. So Ashok, I mean, this stuff is, we were talking years ago, OCR and NLP were being talked about, and it was a little scary for some people. I think that in some industries they said, you always see these images of like the robots and the person touching, it looks like the Matrix or something. But now that we sit here in 2021, I mean, these are becoming mainstream. Instead of reading an invoice, having a solution that automates the image recognition and the OCR, optical character recognition. We at Trullion play a lot in the NLP space, which is just analyzing the text in different agreements. You see NLP being applied in voice. So we have a board meeting this week as a company. That would be interesting if my accounting firm, our lawyers sit in the board meetings and they take notes. That would be interesting if there was voice NLP applied to board meetings, which could help bring that into the accounting workflow. So this is the stuff that we're thinking about. Look, I mean, to really paint the picture, when you have all these new regulations, Ashok, again, like as the internal practitioner, the person who's doing it, this is a lot. Like this is a lot to do. It's a lot to take on in a short period of time. And what we say as a technology company is, well, there's a lot of areas where you have your partners and your teams to help you advise on this, but there's just a lot of unstructured data that's still sitting outside of the GL and the classic GL framework. It's not just in documents, but it's in Excel and it's in emails, and maybe in RevRec you have a performance obligation that's identified in an email with a sales guy, right? Maybe in leases you have an option that has been discussed or indicated and it's sitting in emails. And so as we think about keeping up with these new standards, we at Trullion look at the whole, we're looking at the whole horizon. We're looking at all the things outside of your classic ERP that could be thought about in a workflow. I mean, so Ashok, is there any, what do you dream about when you're working with clients? Yeah.
I was just curious, like, as I mentioned, the data gathering and identification of embedded leases. Like if I think about most of the lease standard adoption work and maintenance afterwards we've done, that part has taken a lot of time. And you are, I know you and I talked about it way back when, and trying to solve that problem. How do you feel about it now? Like using the technology that you guys are using, is it solving some of that? I know it probably won't be solving all of it. Like some of these documents may not be as easy to read, but how do you feel about that overall?
Yeah, well, I mean, we feel pretty good, obviously based on the customer traction and things like that. But I think that the main thing to think about now with technology, and again, I'm just going to go back and make a point. Technology is not always the solution. Excel is really, really good. I don't, this is being recorded, but I'll go on the record. Excel is a great piece of technology. It is automated, right? And it works. But with Excel or a database, there is a cost of ownership of that software. So you think you're paying the license fee for a lease software or revenue software, but you're actually paying additional time to manually enter new data into that solution. And so what we say is you could take that manual process, move it to contract reading and AI, and lower the total cost of ownership of the system. So the system price might stay the same, but you've got half of your day back, or your close period goes down from 11 days to 9 days or something like that. So it becomes a time saver. And I mean, this is a common process, and the paradigm here, right? We're gonna like zoom out a little bit. When you think about AI technology, this would be like a very good lease process, but I want to focus on like auditors too, right? Internal or external. This is the process. Like Ashok said, you would read those PDFs, you would identify and abstract the data, you would put it into Excel or a tool, right? And then you would run reports. Now, from an audit perspective, they would reverse engineer these reports. And so this paradigm became interesting for us because we said, look, if I'm putting in 100 leases and my auditor is only able to sample 3 because they've got to do RevRec and all these other standards, could AI not just lower the cost of me, the controller, the CFO, but also the cost of the whole process and even make it more efficient? And so with what we did, and I mean, some people on this discussion have seen the software, I know you have, but what we did was we took that workflow and we said, well, let's use AI to extract the data. So on the left side, you're talking about source document tagging, right? Start dates, end dates, payments, clauses, helping with the accounting. In ASC 842, you have to identify finance versus operating, apply interest rates, deal with currencies, deal with incentives and improvements and all these things. And if you could connect the source with the accounting all the way down to the disclosure that we talked about, then this could be an ongoing or a recurring process. And what that means is, you go back to your analogy with RevRec and your clients that are still calling you about a contract, right? The goal would be with lease accounting, and what we're doing is that you could put in these agreements, collaborate, whether it's your advisor like Ashok or your auditor, right? Collaborate with them in real time. And the reason you can do that with AI is because the AI is tagging from the source document. So originally we thought, well, this would just save time. You're spending 3 hours, you could do 30 minutes. But then with OCR and NLP, you can connect with source data. And so that made the audit and the overall process more connected. And that was like a really cool moment for us because we could work with both sides of the equation.
Yeah, no, I love that. I know my team members can appreciate it because abstracting the data from the agreements was not a fun process. I think if that time can be saved, they can spend that time in more complex areas.
Yeah, definitely. So we see the like Ashok, we heard a quote yesterday. I think we asked someone what do you think of the solution? We did a demo and she said, well, I'm a CPA, so I don't want to be reading leases. So this is great. And I mean, I think there are a lot of people that genuinely feel like that's, pulling us out of a lot of the strategic things. So just before we get into some Q&A, Ashok, I think we have like 10 minutes left. We could talk forever, but just in terms of where we see it going, the AI is doing a lot of predictive analytics and even a little bit of anomaly detection within the workflow like leases. So one of the questions in the capital versus operating lease test is around a purchase option. You could look at an agreement, a real estate agreement, and be pretty certain that there's no purchase option there, right? And so being able to detect both the likely and unlikely outcomes within the workflow. Another area is around modifications. Modification accounting, we'll do another webinar next year, when people really experience in the private or post-IPO environment what it's like to do a remeasurement or recalculation. With AI and the data and the workflows that we're gathering, you could start to see the different judgments in what makes for remeasurement. Is a 1% increase in payment, a remeasurement? Is a 2-month extension remeasurable? And so those are some of the areas where AI can detect and improve the overall workflow. So I'll leave it at that. We'll share more. We've got a few questions. Ashok, did I miss anything? I think we covered a lot today.
No, I'm just looking forward to automating areas. Me being technical accountant, I'd like to focus on the more complex areas. So whatever we can automate and simplify would be helpful.
Yeah, definitely. So we have a couple questions here, right? One question that is coming up right now, it's live from an anonymous attendee, is how can AI identify an embedded lease? And so before I talk about it, can you clarify for us from a technical perspective, embedded lease, high level, this is the thing that's spooking everyone. What is an embedded lease? What differs or distinguishes an embedded lease?
Sure. So the word, as you can relate to embedded, means it's within another arrangement. And a simpler example can be data centers. Data centers that tech companies use, the overall arrangement may not be a lease because they provide power, they provide remote hands, all the services that come with it, but they also provide a space where you keep all of your hardware. So within that arrangement, if that space is identified, you control it, then that space component would be a lease. So if you just take a step back, that means you have an embedded lease within this data center arrangement. That's what it means simplistically.
Got it. And so from an AI perspective, if you upload any agreement into an AI-powered tool, into the Trullion software, after the OCR and the NLP is done, what's done is called entity recognition. Entities are transactional entities, such as financial data, start dates, end dates. Now, to be fully clear, the AI is not going to check a box that says, yes, this is an embedded lease, or no, this is an embedded lease. This is still an activity that requires a really strong layer of judgment from you or your advisor. But what the AI will be able to do is we'll be able to quickly identify the trigger numbers and words that could force you to look for that and more rapidly identify those embedded leases and then make the notes accordingly within the tagged entities and transactions. We have another question from an anonymous attendee. What data do you have on the quality of AI technology in reading lease agreements with a high level of accuracy? Okay, these are great questions. In terms of accuracy, just to give a number and to level set, I would say that AI, in terms of our AI technology, again, there are companies that only specialize in reading documents or reading leases. We specialize in financial technology. Trullion, we specialize in accounting technology, and so we embed the lease reading as part of the workflow. I would say that we as a company pick up and predict accurately roughly 70% of the terms that you need for ASC 842 from the lease. And that's a really important clarification because it's not 100, right? And it's not close. What it's doing is it's helping get to the data quickly. In our workflow, accounting teams and auditors still need to approve the data that's been extracted. And you'll find that things like start dates, end dates, renewal dates, lessor lessees are a lot easier to find. On the other hand, AI is not going to be able to calculate a complex step rent or forecast a CPI. This still takes critical review from the users. So I hope that helps to the question on the line.
And Isaac, having seen your tool, if I can add one or two items to that response, and I've seen and used some other tools from contract reading perspective too. I think the way you guys presented side by side, if I remember correctly, like you could see whatever on the left-hand side of the screen, if you simply imagine whatever information the tools already read, you can approve it, you can drag and drop. So you can take it from that 70 to 100% pretty quickly is what I remember. So that part was my favorite part, to be honest, not that it matters whether it's 70 or 100, but I really like that angle. Like, here is the date. Do you approve it, or do you drag drop? If the tool didn't pick up a particular term, then you can drop that tagging.
Yeah, absolutely. And we're just showing the last slide. I'll say one more thing on that, Ashok. With AI, like, I think this has been one theme that we've talked about. It's not a catch-all. It's not a 100%. You know, you're done, you're good. It will help you. It will help aid in a lot of these compliance exercises. And if they're increasing in complexity, then again, we do have to, as a community, as a group, as an industry, bridge the gap. One thing is if you do use AI to OCR and NLP and connect the tool within the workflow, like you said, side by side, then what happens is your audit trail extends. Your audit trail extends from the software all the way back to the source data. So these are hard things to calculate, but when a modification comes up, it could take an hour, hour and a half, 3 hours to go through the agreement. And if you previously tagged it, you could do that more quickly. You might get a big question on a material lease from an auditor to take you back to the point in the agreement where you got that data point, right? You could just picture someone in the shoes like, oh, I can't even find where it is. And so that's part of the value, is if you can connect with the unstructured data, you're extending the audit trail and improving the efficiency of the whole process. So that's it. I mean, Ashok, this is great stuff. I mean, for us at Trullion, I hope we are thinking about IPOs and SPACs in the next couple of years. But right now, we've got a big standard coming up next year, and you know, with the dust settling with COVID, we hope we're on a plane and, you know, in LA and with, you know, visiting other clients and stuff. So that's what I'm looking forward to. Yeah, no, would love to meet, and would love to see the progression of the technology where it continues to move further. And I think that workflow angle is important from what I've seen. I've seen a variety of solutions, but when it's part of that versus you trying to extract the data somehow manually or using a technology and then import, I think that just creates another layer that you probably don't need or don't want. So yeah, looking forward to see better and better solutions as we move ahead with this standard and others. So yeah, good talking to you, Isaac, and thanks for having me. Absolutely. Great talking. Thanks everyone for coming. You can reach out to Ashok, Isaac separately, and have a great rest of the day. See you guys. Thank you.